The market, which we define as the S&P 500, rebounded from a horrible October and was up 1.79% for the month of November. The good news for us is our fund was also positive, finishing up the month with a healthy 3.05% gain for November. The value of shares in our fund started the month at $10.24 and ended the month at $10.55. As you know, my goal is to manage to beat the S&P 500. For the month, we outperformed the S&P 500 by 1.26%. This changes my total performance for the year since January 1 to up 5.48%. As of the end of October, we were up only 2.36%. As a result, my annualized rate of return is now 7.31%. Over the course of 2018, we've now built up a solid performance relative to the S&P 500. We're outperforming that standard by 3.09%. As we discuss every month, we try and find stocks that are undervalued, buy them, hold them till they go up 15%, sell the original investment, and keep the profits as a long-term investment. This month we had 3 stocks which qualified for that. Those stocks were H&R Block, Ventus, and Thomson Reuters. H&R Block is a bit of a victory of preparation meeting opportunity. I already owned a position in H&R Block, but the company tanked on some marginally bad news. I didn't think the news was really that bad, so I doubled down on my position. It worked out, and now I've converted that second stake into a long-term hold while still holding the original investment. Here you can see a chart of the purchase price, days held, return on investment, and annualized return for these 3 positions. The outsized dividend in TRI, which is Thomson Reuters, was a result of a sale of division to BlackRock, which, through a relatively complex transaction, spun off a significant dividend to shareholders. So H&R Block we bought and held for 147 days. We had a return of 18.09% while we owned it, and that resulted in an annualized return of 44.93%. Ventas, we had a return over the time we owned it of 18.09%. That, by the way, those returns are the result of the 15% gain in the stock price plus some dividends while we owned it. We owned that for 194 days. That's an annualized return of 35%. Thomson Reuters we owned for just under a year, 361 days. We had a 33% return, again, because of that outsized dividend, and that resulted in a 34% gain. So each of those was really solid investments, both in terms of absolute performance and in terms of an annualized rate of return. When I sold these 3 stocks, I had room on my portfolio for 3 new stocks. I elected to buy stocks in a company called PetMed Express, Apple Computer, which we've owned before, but which price had dropped significantly and I still think is a fantastic company, and Winnebago, the manufacturer of RVs. Here you can see the purchase price, the date purchased, and my expected sales price for PetMed Express, Apple Computer, and Winnebago Industries. This month we added marginal amounts of new cash to the fund, less than 0.1%, so it's really not worth discussing. 7 stocks paid a dividend for the month. That equaled to about 0.5% of the portfolio's value. Cash on hand remained below 1% as we're basically fully invested, and that's the second month in a row we've been that way. All too often investors simply look at how much the stock appreciates and they ignore the dividends that the stocks are throwing off. We really like to focus on that. If I have a choice between 2 companies, I'll typically choose the one that pays a higher cash dividend. I like the fact that the company is throwing off profits to our shareholders. And unless the company has a very strong evidence of being a good compounder in terms of using their retained capital well, I'd prefer to have the money come to me. So here's a chart of our dividends to date. We look at dividends both on a monthly and quarterly basis, only because we don't have very much data. 2 or 3 years from now, we'll stop looking at them on a monthly number and look at them only quarterly. We do that because different stocks pay dividends different quarters, and so the months tend to be lumpy in terms of the results. Over the long term, we would expect that every quarter our dividend should increase. This is because we have companies that generally, hopefully, tend to do better and better. It's because we tend to own more companies over time because we've moved companies from the short term to the long term and created new investment, and because we will be adding new funds into new investments, cash into the funds. So here's a look at our performance on a quarterly basis and on a monthly basis. You'll see that the month of November had a significant bump in it. That's because of the one-time dividend payment for Thomson Reuters, which is a one-time event and shouldn't be expected to continue. However, the good news is when looked at on a quarterly basis, you can see that our 4th quarter, even though we have no results for December, is already going to be a record quarter. So, in summary, stock investments were up 3.05% for the month. The S&P was up 1.79%. Therefore, we outperformed the S&P 500 by 1.26%. For the year, we're outperforming the S&P 500 by 3.09%. We had 3 stocks pass the 15% appreciation threshold and become long-term investments. The long-term investments now have 19 stocks in it, totaling about 14.7% of the fund based on today's value. I added 3 new stocks to the fund: PetMed, Apple, and Winnebago, giving me 16 stocks in my active fund. Cash remained at less than 1% of assets. This month again, we did no new research and we found no new solid firms to track. And we found 0 stocks cheap enough to warrant investing. Thank you very much, and we'll talk to you again about December.